Good morning, everyone, and welcome. We're thrilled to have you join for us in this session on Angel One Nifty Total Market Index ETF. To guide us, we have Mr. Samir Desai. He's a Chief Business Officer at Angel One AMC. He has over 35 years of experience in the capital markets, including 15 years in ETFs and the index ETFs. Mr. Desai has been instrumental in shaping India's passive investing landscape. And today, he will share insights on how index ETFs like the Angel One Nifty Total Market Index ETF can simplify investing and help investors participate in India's growth story. So let's get started. Over to you, sir.
Uh, Thank you, Jeffrey. Good to be on your show and wishing all your investors a very good morning.
Yes, sir. So we'll start off, sir. Our We're going to have this in a little bit of a conversation. So we'll start off with the first question. What
Sure.
is the Angel One Nifty Total Market ETF about, and how does it differ from other ETFs that are there in the market, sir?
Yeah, so it's a very pertinent question, Jeffrey. So as the name suggests, the Angel One Nifty Total Market ETF is designed to track the Nifty Total Market TRI. TRI stands for the Total Returns Index. Okay. This is a index capitalization weighted index designed by the NSE to track the performance of 750 companies across large caps, mid caps, small caps, and micro caps. Okay, so all these segments of the Indian stock market are tracked via a single index. Also, I would like to inform the audience that this is the first ever ETF on this particular index. Okay, so there are no ETFs on the Nifty Total Market Index, and ours was the first launch. Now, other ETFs track a specific segment of the market or a sector. So, for example, a Nifty 50 ETF tries to capture the characteristics, behavior, and performance of mega large cap companies represented by the Nifty 50 index.
Okay.
Likewise, a Nifty small cap 250 ETF for small cap companies, sector ETFs for those tracking pharma, IT, banking, auto indices, and so on. So those are the respective sectors. And you also have thematic indices such as MNC, digital, PSU, as well as smart beta indices that include factors like momentum, value, quality, and so on.
Okay, sir. So the next question we have is, what is the significance of the Nifty Total Market Index that covers large cap, mid cap, small cap, and the micro cap? And how does this broad coverage actually benefit investors, sir?
Yeah, so there are a lot of benefits. So the objective of the total market index is to help the investor eliminate the guesswork associated with stock specific, sector specific, and fund manager specific predictions. So there is no need to, indulge in stock selection, fund manager selection, sector specific predictions. So let me put this in perspective. So currently, there are over more than 4,000 listed companies, and we have over 500 equity-oriented mutual fund schemes. Now, if we add equity-oriented PMS and AIF portfolios, then the number is even higher. So for a typical equity investor to navigate this confusing landscape is an immense challenge. Therefore, stock selection, fund manager selection, factor selection, etc., are equivalent of guesses. Hence, they are risks as it is akin to predicting the best future outcomes in the present. So you practically need a crystal ball to see the future outperformers, whether it is fund managers, stocks, or specific sectors. So Nifty Total Market Index is the index that can help an investor do investment without guesswork, which is what you see embroidered on my t-shirt. So this is our, practically our tagline, investment without guesswork. So it does away with the tyranny of predictions, okay, which is what an investor faces time and again. So I will, summarize this as a cut the clutter index. And this is one product which is evergreen, perennial, and therefore it is almost like her portfolio ke liye.
Okay, that's nice, sir. So my next question to you, sir, is how does this fund provide exposure to 95% of India's full market capitalization?
Yeah, so currently these 750 companies that comprise this index are a combination of 100 stocks of the Nifty 100 index, which represent the large cap segment, 150 stocks of the Nifty mid cap 150 index, which represent the mid cap segment, 250 stocks of the Nifty small cap 250 index, which is the small cap universe, and 250 stocks of the Nifty micro cap index, which is the micro cap segment. Therefore, all 750 companies in the aggregate, as of 28th March 2025, represent approximately 95% of NSE's full market capitalization. So how do you see this? So relative to this, Nifty 50 gives you a coverage of only about 45%. Likewise, Nifty 500 also gives you a lesser coverage. Okay. So this index, the total market index, is the mother of all indices, as it represents almost the entire Indian stock market capitalization, sectors, segments, and investment styles, that is value, growth, and so on and so forth.
All right, sir. So what we'd like to understand is what is the investment strategy of the Angel One Nifty Total Market ETF and how does it ensure efficient tracking of the Nifty Total Market TRI?
So Angel One Nifty Total Market ETF is managed by the fund manager, our colleague who has been associated with ETFs and index funds for over 20 years. So hence our endeavor will be to ensure that the tracking error is as low as possible for this ETF.
Okay, sir. So according to you, what are the key benefits of investing in a broad market index fund compared to segment-specific funds like the large cap or the small cap, sir?
See, whenever an investor decides to invest in segment or sector-specific funds, the implication is that the investor must take a segment or a sector-specific view. So let me give you an example. For example, when an investor decides to allocate monies to large cap segment, then by default, the implication is that the investor is more bullish on large caps relative to mid caps and small caps. So he's taking a view. Or let's say the investor decides to allocate a sizable quantum of the portfolio to pharma sector. Then again, it is a view-based decision. And if the allocation is to a large cap active fund or an active pharma fund, then the investor is taking the additional fund manager risk, which is absent in the large cap ETF or the pharma ETF.
Yeah.
If the investor decides to invest in, let's say, specific large cap stocks, individual large cap stocks or individual pharma stocks based on his research or based on the advice that he is getting, then it is stock specific risk. So all these active decisions may or may not be favorable in the future relative to the broad market index. So as far as the Nifty Total Market Index is concerned, all guesswork associated with market segments, stocks, sectors, and fund managers is thereby mitigated.
All right, sir. So we'll also like to understand, sir, from your perspective, what are the advantages of using a passive approach and why has Angel One AMC decided to focus only on ETFs and index funds?
So that's a very good question. So the reason for being a passive only AMC is because active and passive are totally different asset management philosophies. And if both are offered together, it sends conflicting signals to investors. So passive investing eliminates non-systemic risks of stock selection and fund manager selection risks, and thereby the investor benefits.
All right, sir. That actually makes sense. So historically, how has the Nifty Total Market Index performed compared to other indices like the Nifty 50 and the 500?
Yeah, so this is also a very pertinent question. So our internal studies done over the last 20 years, so from beginning April 2005 till end March 2025, and these studies consider a lot of data points because it's a rolling returns analysis. Now, in most of the time frames over the last 20 years, based on the rolling returns analysis summary, if we summarize the studies, then for most of the time periods, the Nifty Total Market Index has outperformed the narrower indices, Nifty 50 and Nifty 500. So, for example, if I consider a 10-year rolling time period, okay, then you have 2,477 data points. So these are the 10-year rolling time periods in the 20-year time frame over which the study was conducted. Now, in this, in 2,477 data points, 98% of the time, the Nifty total market outperformed Nifty 500 index, and 82% of the time, it outperformed the Nifty 50 index. This isn't surprising because Nifty 50 and Nifty 500 give you a lesser coverage. So in a growing economy, it is the total market which is actually beneficial over long periods of time.
Absolutely, sir. So my next question to you, sir, is what are the main risks associated with investing in this fund and how could they be managed effectively, sir?
So Jeffrey, let me start answering your question. I'm reminded of what Dr. Paul Samuelson, the first American Nobel laureate in economics, he once said that investments should be dull and boring, like watching the grass grow and the paint dry. If you want excitement, take $800 and go to Las Vegas. So if I may say, if I may say in slight humor, the only downside of a total market index is that it is not exciting. Okay, you just buy the entire market and sit. Stock picking, fund manager selection is an adrenaline pumping activity, but the outcomes may not be desirable. So investments should be dull and boring, like buying the total market. But to give you a slightly more technical explanation, investing in equities entails two major risks: systemic risk and non-systemic risk. Systemic risk is the market risk, and this is the non-negotiable or the non-diversifiable risk. What this means is that market risk is common to all forms of investments, whether one is investing in an index ETF, active funds, stocks, whatever one is doing. For example, if there is an outbreak of a pandemic or a war-like situation, the entire market will slump. Indices, active funds, as well as individual stocks. So this is your systemic or the market risk. Over and above the market risk, there is the non-systemic risk or the additional risk, which is the stock selection risk and the fund manager risk. Now, this is over and above the market risk. What happens is taking these additional risks may not result in a higher expected return over an index. So all additional risks may not give you the expected higher return, is what I'm trying to say. Therefore, by investing in the Nifty Total Market Index via the ETF route, the only risk is the market risk, and the additional risks of consistently trying to select the right stocks, outperforming fund managers from the numerous choices available is a task, and the serious risk is of not being able to obtain the market return, which is easily available to an investor via the Angel One Nifty Total Market ETF. I'm also reminded of what a famous financial columnist in the US wrote in the Wall Street Journal many years back. He said that indexing liberates you from having to, by making you say, I don't know and I don't care. What he meant was whether I should go for value or growth stocks. An index ETF allows you to say, I don't know and I don't care, because both value and growth are contained in the Nifty Total Market. Whether I should go for banking sector, pharma sector, auto sector, the total market index investor can say, I don't know and I don't care. So the tyranny of predictions, which is what causes problems in the stock market, the investor does away with, is what is meant by this.
I think this links into the next question also, sir. So who is this fund suitable for, and how much of an investor's portfolio should ideally be allocated to this fund?
So time and again in investments is, what I call is an investor is faced with the dilemma. So the investor always wishes for, can I have just one fund which covers all market segments, covers all themes, covers all investment styles, covers all sectors, eliminates fund manager bias, has performance aligned to its benchmark index, and is also cost effective? Then the answer to all the above is the Angel One Nifty Total Market ETF. Therefore, this is the only product that investors may have as their entire equity allocation because you are covering the entire stock market. So this makes it an evergreen product suitable for all investors, retail, HNI, and as I had said earlier, let me reiterate, it is for her portfolio ke liye.
All right, sir. So my last question to you, sir, is what is the expected tracking error for this fund and how does it impact overall return for investors?
So it may not be possible, Jeffrey, to predict the tracking error. However, considering the long experience of the codes in the passive asset management industry, we will endeavor to keep this number as low as possible to ensure that the ETF has its return as close as possible to the Nifty Total Market TRI, which is the Total Returns Index. And I also want to inform the audience that while the discussion was about the Angel One Nifty Total Market ETF, we also have this index available in the index fund format. So that product is the Angel One Nifty Total Market Index Fund. So currently we are the only AMC to make the Nifty Total Market Index available in both the ETF format as well as the index fund format.
All right, sir. So these were the questions that we had for the fund and for the ETF. And then we're really, really appreciative that you actually came on and gave us time. Is there anything else that you'd like to put in, sir, for final comments?
Well, so I'll just, like to summarize in a sense that this, index ETF or the index fund, the total market, should be the foundation of any portfolio. Okay, so one may, follow a core and satellite approach where the core has to be the total market index product. Okay, because that will at least give you the market rate of return. The satellite component can be any of the alpha strategies. So whether it is stocks, alpha funds, AIFs, PMSs, active funds. So that can be the satellite component of the portfolio. But in the core component, one has to eliminate all the guesswork and the risks of predictions.
All right, sir. So we really appreciate you giving us time and thank you for everybody for attending. We hope today's session on the Angel One Nifty Total Market Index ETF was insightful. A big thank you to Mr. Samir Desai for simplifying the passive investing and explaining how this ETF is truly her portfolio ke liye. So our key takeaways from our webinar today is why passive investing is gaining popularity, the ETF's exposure to 750 stocks across all market segments, and how to use the index ETFs for cost-effective diversification. So till the next time, stay tuned for more educational webinars. And thank you again, sir.
Thank you, Jeffrey. Pleasure being on your show.